three key signs that a major reversal is about to happen. One of the things that we've been discussing is that traders react too late. They don't see what's happening until it's already happened. So reversals catch them off guard. But one of the things we talk about is the market always leaves clues. And if we can be aware of these clues and we can perceive them and we can keep a clear mind, because oftentimes what happens is we're bullish, the market's going up, and we don't want to hear that the trend is going to end. So sometimes there's unassailable evidence that's right in our face and we ignore it because it doesn't actually work with what we want psychologically. So, but if we can have a clear mind and we can see it for what it really is, we can start to make decisions. And then price action helps us to be able to see what's happening faster, helps us to be more decisive, and helps us to be able to make decisions to get in and get out at better levels. When we talk about the three key signs, one is there's typically a climactic volume spike. And there's a surge in volume without price continuation, or there can be a surge in volume actually with very big price continuation. And this is the part that often really confuses traders. I know for me, it was the part that confused me because the conventional wisdom is that if a market goes higher on strong volume, that's very bullish. And if a market goes lower on strong volume, that's very bearish. But when we get these climactic volume spikes, what you're going to see massive volume that's in the direction of the trend, and that'll be it. It fits the tenet of, while the market's going down and the volume's increasing, that's bearish. So people see this and they get super bearish, but the reality is that the market has had a climax. It's had an exhaustion and the market's over. The second part is you can get a failed breakout or a failed breakdown in which you break a key level and then you immediately reverse. And then finally, we have momentum divergences. And this is where the price makes a new high or price makes a new low, but volume does not confirm it, or relative strength does not confirm it. So those are the three key signs. We'll go through some examples so you can see them. Why do most traders get caught on the wrong side of trends? Well, the painful truth is that traders often chase strength at the exact worst time. So they enter long when the trend is already exhausted. They short after a massive drop right before the market bounces. Or they rely strictly on indicators, and their indicators are late. So the indicators are telling them one story, but what's in reality, what's happening is the market's already shifted and the indicator's not picking it up. So what's happening is traders are so often reacting to old information. They're reacting very emotionally. And instead of seeing what the market is actually doing right now, they have a story that they're trading off of. We talk a lot about this concept of runaway volume. Runaway volume is foundational into what we teach. And if you go through the Code Breaker workshop, you're going to learn about runaway volume and you're going to understand why it is so foundational. Runaway volume allows us to be able to really see what's going on in the market that without it, it's not as clear. So typically what we'll get is in the early stages of a move, we'll see runaway volume that's pushing the move. And it's typically accompanied by aggressive momentum, or what we call expanding and accelerating momentum. Then we get to exhaustion bars. And exhaustion bars are basically in a formation that we get big volume with little price progress. What that's telling us, when we have big volume, but we do not have range, what that's telling us is that a big seller has met a big buyer. And they are trading a massive amount of size at one price. So if we can combine these with price structure, we'll know when to get in before the momentum really starts to accelerate. And that's one of our big objectives, is we try and get in the early stages of momentum. We don't want to be entering late in momentum if we can help it. It'll also help us to know when to stay out so we don't get trapped. And it'll also help us to know when to prepare for a major reversal. I showed this in the last couple of weeks, but This flow diagram is worth coming back to again and again and again and again. So as we've said, the only two leading indicators are flow and volume, and flow is not available to a typical retail trader. There are places that you can examine flow, but typically if you are going to be heavy in flow, you're only going to be able to trade one market, maybe two. You cannot trade multiple markets with order flow. It's too much to follow. But volume is something that we can all use, and we can use it with scale, and we can use it in a fractal manner across different time frames and different asset classes. And the behavior can be a little different from product to product for sure, but it has similar interpretations. So we can use this all the time. And then, as we mentioned, those are the two leading indicators. And then volume that's impactful leads to volatility. And volatility that's sustained leads to momentum. And then momentum, if we get a series of momentum waves, that creates a trend. And if we get a trend, trends at some point go too far and they become overbought or oversold. Same with momentum, same with volatility. Overbought, oversold is featured in all three of these indicators. We get overbought, oversold, we get reversion back to the mean, and the whole process starts anew. All right, so I just want to keep this top of mind because we're going to be talking about it again today. So one of the things we said also is that the primary focus of a professional trader is order flow, volume, and volatility. The primary focus of an average retail trader is momentum, trend, and overbought, oversold. So all these indicators that measure momentum, that measure trend, and measure overbought, oversold. So trading success is not going to be just about your technical strategy. It's also going to be about managing your energy, your mindset, and your focus. I'll come back to this in a minute. So I want to go through some charts, and I want to show you some examples. So one of the things I say is that very often volume is a process. It's not a single event, it's a process. So to really be able to interpret volume, most of the time, it takes some time. And time can be a matter of months in some cases, and time can be seconds in other cases. But it really comes down to the time frames we trade and being able to get feedback about what we see in the chart. So we're going to go through a couple examples. So one of my students, we had a discussion yesterday about this name right here. So when we look at Verint, it had PM earnings on Wednesday. So earnings came out after the close, and then we had a major gap down yesterday. We had a major gap down. Okay, so this is an example of something that really confuses traders. We have this big gap down. So what are we going to do with it? Can I sell this? Is it oversold? Should I buy it? Should I not trade it at all? Where am I wrong? If I'm going to trade this, how do I know where I'm wrong? And this causes a lot of confusion. But this is a type of thing that we're talking about. So when we go through and we see this candle, this big gap down, we had a catalyst. I have some excellent videos on YouTube in our Trader Tip Tuesday video series. There's some excellent videos on catalysts. If you haven't watched them, I highly recommend that you go watch these videos. So one thing that's really important to understand is that a catalyst is something that comes into the market and smashes fair value. It causes some sort of instantaneous change of what fair value really is. Now, when we talk about fair value, it's important to understand that fair value is elusive. It is not a constant number. Sometimes it moves a little bit, sometimes it moves a lot. It can be stagnant for a period of time. And then ironically, the more fair value stays at one price, the more confidence people have in the fair value, the more willing they are to trade. But what's ironic about it is the real money is made not by trading around fair value, but actually understanding when fair value moves and it gets dislocated, how do you trade it then? So a great example I'll use for you to kind of get the understanding of this is that, let's just say for argument's sake, you were going out and you want to buy a house in your neighborhood. And you go out and you look around and at houses in different neighborhoods and you find the one that you like. You say, okay, this is a house we're interested in buying. Let's just say for argument's sake, that house is $750,000. Okay, so the house is for sale for $750,000. You like it. What's the first thing you're going to do? That's right. You're going to tell the realtor to go pull the comps. Why do we pull the comps? Because the comps are going to give us a sense of fair value. So let's just say for argument's sake, you go out and there's 14 comps in the neighborhood. And those comps are between 725,000 and 775,000. You go through and you look at the different houses, and some of them are nicer and some are at better location, some are bigger, some are smaller. But you look at it and say, okay, like there's a lot of houses that have been sold in this neighborhood in the last year. So what does that do for you? That gives you a lot more confidence that fair value is actually somewhere in the neighborhood of what you're looking at. So you say, okay, it's worth 750,000. So what are you going to do? You can try and bid it, put a bid in lower. You're going to try and bid 725 or 730 or 740. And then you're going to hope that the seller counters. Let's say they count the seller counters and you eventually end up buying it for 745,000. Well, at that point, you bought it for $5,000 under fair value. You feel really good about yourself because you bought it for under fair value. But what I want you to see is what gives you confidence is that there's 14 other comps out there. Now let's look at another house. We go look at another house. This house is also $750,000 and you like it. But when you go and you pull the comps, there's only 3. And none of them are in your neighborhood. The nearest one's a mile away. And when you pull them, one is 480,000, one is 540,000, and the other one's $1 million. How do you feel about fair value now? You have no idea. And this, ironically, this gives you less confidence to be able to place a bid. So then because you have less confidence, you might not do it, or you have a lot more anxiety about it. But the interesting thing is, if you look at these two scenarios, the one that has 14 comps in a tighter range, and the one that has 3 comps that are nowhere near the asking price and nowhere near in location, which one has the better opportunity to make money? The second. The second has the better chance to make money because you could put in a bid for the second house at 600,000 or 550,000 and you might get it. Now you have room to be able to actually sell it. Even after commissions and fees and everything else, you can still make money on that house. If you buy a house for 745 and you turn around and sell it, you're losing money after fees. So fair value it can move. It's elusive. And we're gonna make the most money when fair value is not known. This is what causes trends. Trends occur because nobody really knows what fair value is. All right. So now when we bring it back to these charts and we look at this, when we see this gap down, this gap is going to start to give us a sense, okay, is this too far? Is it too far from fair value and it's going to come back? Or is there a new appraisal of fair value going on and it might go lower? So for example, what we're going to do is we're going to look at this bar. And with this bar, if we are able to close lower, one of the things we're looking at is, has the selling stopped? If we close lower the next day, we know the selling is not done. And if the selling is not done, even though it might be extreme, even though your indicators would say it's oversold, you have a catalyst that's changed fair value, and now you have selling that remains in the market. And so this market is going to go lower in spite of what your indicators say. So if we get a close below this low, this is one of the patterns that we'll go through and we'll look at. This actually sets up a signal that tells us we have trend continuation. And then if we go short here, we don't need to put our stop or our risk point somewhere up in here. We can put it above this high, knowing that, okay, if we take out this low, no way should we take out this high. So in this case, it's taken 2 bars to be able to properly interpret it. But if we close inside this and especially if we close a little bit higher, what that's telling us is that the selling is done. How do we know? Because if there was still selling remaining, the market would have gone lower, but it didn't. So when that happens, now you start to create what's called an exhaust. And in the exhaust, now we start to analyze what comes next. Just because we start to see signs of exhaust, we call this an exhaust condition. This doesn't mean that we have an exhaust. It means we have a condition for an exhaust. We have an environment for an exhaust, but the market may reassert itself. So we're looking at this in stages. And so a big gap down like this could actually be a great place to get short.